Bridgewater. This is Finance Paris Team 11, and we're here to help you optimize your portfolio to bring it at its best. We assure you, we'll surely get you to the stock treasure. Based on our research, our findings about Bridgewater Asset Management Fund is as follows. Bridgewater is a passive fund that is focused on asset allocation in different equity indices. Its two biggest holdings are SPY with 11.93% and 5.71% of their portfolio. The fund combines domestic and international investments. The fund seems to have a higher allocation on domestic equities depending on the short-term outlook. When emerging markets deliver higher returns in terms of economic expansion, the fund shifts its indices invested in those countries.
So as we can see in the slide, for plot 1 shows the current performance of the portfolio in comparison with SPY 500. It's evident that we need to rework on the portfolio to get the graph heading up and perform better. For plot 2, refers to the performance of Bridgewater as compared to the competitors. It seems we have a scope to take your portfolio in better position to overperform competitors. In order to study the existing portfolio, we have taken a sample of 15 stocks to derive a good portfolio. Diversification is the main key. The choice of stocks was done keeping in mind to evaluate assets from different industries and many other criteria which we'll explain further. You can see in the list of stocks, we have picked a sample of your analysis. It includes various ETFs, aggressive and conservative stocks, market giants, and etc.
Now, let's start analyzing our options to optimize the portfolio. We further use L-code functions for composing return to get the annualized return, followed by analyzing different parameters to study individual stock performance and also combined portfolio performance. We calculated standard deviation, tracking error, and it compared to benchmark only. We found that portfolio has low Sharpe ratio, low return as compared to competitors, although it is diversified quite well, but presence of several underperforming assets is affecting the overall performance.
Considering all the facts we said so far, it is very important to optimize this portfolio to get the best returns in minimum risk. Our team has a couple of options to show how this same portfolio can perform exceptionally well. In option A, our main focus is to reallocate low return stocks with lower weight, but their presence would surely balance the risk. Then give more weight to riskier asset, which increases our Sharpe ratio and therefore our returns, however, with the measured risk. In option B, we have selected the most significant weights from the option A and studied the new portfolio. Costco and Coca-Cola are high-performing, high-risk assets, and gold is negatively correlated to other two stocks, and that would lower the risk of the portfolio for a better Sharpe ratio.
The efficient frontier shows us that for the same level of risk, Costco is offering a higher return compared to KO and GLD. Considering all the facts and figures, it's evident that this is giving great returns for almost the same Sharpe ratios as option 1. However, the standard deviation is almost doubled in option A. As a conclusion, we will choose option A because our portfolio on option B only has 3 stocks. Even if it's the high-performing stocks, the standard deviation on this portfolio is way too high comparing to the option A without the significant increase in the Sharpe ratio due to its high volatility. Option A is the best for good returns, good diversification, and therefore a low risk. Also, in option A, portfolio assets with lower rates can be sold in future and replaced by performing stock in order to gain more returns and maintain portfolio performance consistency. Thank you, everyone. That was Finance Pirates 11.